Something was buried inside the Federal Reserve's January meeting minutes that should have every American paying attention right now. But almost nobody caught it. The financial media glossed over it. Wall Street ignored it. The White House pretended it did not happen. And the reason nobody wants to talk about it is because what the Federal Reserve just signaled contradicts everything you have been told about where interest rates are going this year. For months, you have heard the same story from every financial commentator, every news anchor, every Wall Street analyst. Interest rates are coming down. The Federal Reserve is cutting. Relief is on the way. Mortgages will get cheaper. Borrowing costs will fall. The economy will get a boost. That was the narrative. That was the plan everyone was counting on. But on February 18th, the Federal Reserve released the minutes from its January meeting, and buried inside those minutes was a single paragraph that changes everything. Several Federal Reserve officials discussed the possibility of raising interest rates. Not cutting, not holding, raising. Going back up, reversing direction entirely. And the fact that this conversation is even happening inside the most powerful central bank in the world tells you that the situation is far more dangerous than anyone is admitting publicly. Let me be clear about what this means. The Federal Reserve just spent the last 3 meetings of 2025 cutting interest rates. 3 consecutive cuts of 25 basis points each. Markets celebrated, investors cheered. Home buyers started planning. The assumption was that cuts would continue through 2026, and rates would gradually return to levels where ordinary Americans could actually afford to borrow money again. But instead of continuing that path, the Federal Reserve hit pause in January. They voted 10-2 to hold rates steady at 3.50 to 3.75%. That alone was a warning sign. But what happened inside that meeting room was far worse than a simple pause. Several officials explicitly stated that they would support raising interest rates if inflation remains above the 2% target. That language is not accidental. Federal Reserve officials choose every word carefully. When they put the possibility of rate hikes into official meeting minutes, they are sending a message. They are telling you that the direction of monetary policy could reverse. They are telling you that everything the market has priced in, everything investors are counting on, everything the White House is demanding could turn out to be completely wrong. And the timing of this revelation could not be worse. Because right now, at this exact moment, the American economy is trapped in a contradiction that the Federal Reserve does not know how to solve. On one side, you have employment data that looks strong. January payrolls came in stronger than expected. Unemployment dropped to 4.3%. The labor market appears stable. On the other side, you have inflation that refuses to die. Core Consumer Price Index has slowed to 2.5%. That sounds like progress until you realize that 2.5% is still 25% above the Federal Reserve's 2% target, and the trajectory is uncertain. Multiple Fed officials and private sector economists have warned that inflation could tick back up rather than continue falling. Liz Ann Saunders, the chief investment strategist at Charles Schwab, one of the largest financial institutions in the world, went on national television after the minutes were released and said she would not rule out rising inflation. Charles Schwab has already moved their forecast for a second rate cut to later in 2026, not earlier. Later. That tells you what the smart money is thinking. That tells you what the institutions with billions of dollars at stake actually believe is going to happen. And it is not what you are hearing on the evening news. Let me show you why this matters so much, because the difference between interest rates going down and interest rates going up is not a small technical adjustment. It is the difference between economic recovery and economic catastrophe for millions of American families. Right now, the federal funds rate sits at 3.50 to 3.75%. That rate determines what you pay on your credit card, what you pay on your car loan, what you pay on your home equity line, what you pay on your student debt. It influences your mortgage rate, your business loan rate, and the rate your local government pays to borrow money for roads and schools and hospitals. When that rate was near zero during the pandemic, borrowing was practically free. When the Fed raised it aggressively to fight inflation, borrowing costs exploded. And millions of Americans are still struggling under the weight of those higher costs. They were counting on rate cuts to provide relief. They were counting on monthly payments going down. They were counting on being able to refinance their mortgages at lower rates. They were planning their financial lives around the assumption that rates would fall. Now imagine what happens if rates go up instead. Let me walk you through the numbers because the numbers are devastating. There are currently $12.6 trillion in outstanding mortgage debt in the United States. The average 30-year mortgage rate right now is approximately 6.5%. If the Federal Reserve raises rates even once, mortgage rates could push above 7% again. If they raise multiple times, we could see 8% mortgages. We could see 9%. At 7% on a $400,000 mortgage, your monthly payment is $2,661. At 8%, it jumps to $2,935. At 9%, it reaches $3,218. That is an extra $550 per month compared to 7%. That is $6,684 per year. For a family earning the median household income of around $75,000, that increase alone consumes nearly 9% of their entire pre-tax income. Housing becomes unaffordable, not gradually but suddenly. And mortgages are just the beginning. Americans currently hold $1.14 trillion in credit card debt. The average credit card interest rate right now is 20.7%. If the Fed raises rates, that goes higher. Every quarter point increase adds roughly $2.85 billion in annual interest charges across all cardholders. That money comes directly out of consumer spending. It does not go to groceries, it does not go to restaurants, it does not go to small businesses. It goes to interest payments on debt that is already crushing American families. Auto loan debt stands at $1.66 trillion. Student loan debt at $1.6 trillion. Total household debt in America has surpassed $17.9 trillion. Every single dollar of that debt becomes more expensive to service if interest rates go up instead of down. And here's the part that should terrify you. Delinquency rates are already rising. Credit card delinquencies hit their highest level in over a decade in 2025. Auto loan defaults are climbing. Personal bankruptcies are increasing. These are signs of an economy where consumers are already stretched to their absolute limit. They cannot absorb higher rates. They are already drowning. Raising rates would push millions of families underwater financially with no way to recover. Now let me show you the political dimension of this, because what is happening between the White House and the Federal Reserve right now is unlike anything we have seen in modern American history. President Trump has repeatedly demanded that the Federal Reserve slash interest rates immediately. He has publicly called for rates to drop to 1%. 1%. The Federal Reserve is currently at 3.50 to 3.75%. And discussing the possibility of going higher. The gap between what the president wants and what the Federal Reserve is considering is enormous. That gap is not just a policy disagreement. It is a structural threat to the stability of the American financial system. The Federal Reserve is supposed to be independent. That independence is what gives the dollar its credibility. That independence is what makes foreign investors willing to buy American debt. That independence is what separates the United States from countries like Turkey or Argentina, where political leaders force central banks to cut rates, causing inflation to spiral out of control. When the president publicly pressures the Federal Reserve, it undermines that independence. When markets believe that the central bank might cave to political pressure and cut rates even though inflation is still above target, they start pricing in higher long-term inflation. When they price in higher long-term inflation, bond yields rise. When bond yields rise, borrowing costs for the government increase. When government borrowing costs increase, the deficit grows. That cycle feeds on itself. And here is what makes this moment particularly dangerous. The Federal Reserve is facing a situation where every option is bad. If they cut rates like the White House demands, they risk reigniting inflation. Inflation that took 2 years and enormous economic pain to bring from over 9% down to 2.5%. All of that progress could be erased in months if they cut prematurely. Consumer expectations for inflation would spike. Businesses would raise prices knowing that cheap money is flooding back in. The wage price spiral that nearly destabilized the economy in 2022 and 2023 could restart. If they hold rates steady, they maintain the current squeeze on consumers and businesses. Families continue struggling with high borrowing costs. Small businesses cannot afford to expand. The housing market remains frozen. Economic growth stagnates, and the political pressure intensifies because the president can point to a slow economy and blame the Federal Reserve. If they raise rates, they trigger what could be the worst recession since 2008. Consumer spending collapses. Businesses lay off workers. The stock market crashes. Housing prices fall. The entire financial system comes under stress, and the political consequences would be catastrophic. There is no good option. There is no painless path. There is only the least bad choice among terrible alternatives. And the fact that Fed officials are even discussing rate hikes tells you how seriously they view the inflation risk. They would not put that language into official minutes unless they believe there is a real possibility they might need to do it. They are preparing the market for a scenario that nobody wants to believe is possible, but that the data says might be necessary. Let me show you why the inflation problem is more stubborn than anyone expected, because this is the core issue. This is why the Federal Reserve is trapped. Core CPI at 2.5% sounds close to the 2% target, half a percentage point away. That should be manageable, but here's what the headline number hides. Housing costs, which represent the largest component of CPI, are still rising at over 4% annually. Food prices have not come down. They have merely stopped rising as fast. Energy costs are volatile, and one geopolitical shock in the Middle East could send oil prices spiking overnight. Services inflation remains sticky at over 3% because services depend on labor costs, and wages are still growing at nearly 4% annually. The easy part of disinflation is over. Bringing inflation from 9% to 3% was relatively straightforward. Supply chains normalized, energy prices stabilized, but bringing it from 2.5% to 2%, that last half point, that is the hardest part. That is where every previous inflation fight in American history has gotten stuck. That is where the Federal Reserve has to make painful choices that hurt real people and real families. And there are new inflationary pressures building that did not exist 6 months ago. Tariff threats from the current administration could raise import prices on thousands of products. Trade tensions with China, Mexico, and the European Union create uncertainty that businesses pass along to consumers through higher prices. Government spending continues to add fiscal stimulus to the economy even as the Federal Reserve tries to cool demand. These cross-currents make the Fed's job nearly impossible. This is why Wells Fargo's economists have pushed their forecast for rate cuts to June at the earliest. This is why Charles Schwab moved their second cut prediction to late 2026. This is why the bond market is repricing expectations. This is why smart money is preparing for a scenario that most Americans have not even considered. That rates might not come down at all this year, that the relief everyone was promised might never arrive, that instead of lower monthly payments, Americans could face higher ones. Now let me show you what happens to the stock market in this scenario. Because if the Federal Reserve raises rates or even holds them at current levels far longer than expected, the consequences for your retirement savings are severe. The stock market rally of the past year has been built almost entirely on the expectation that interest rates would fall. Lower rates make stocks more attractive because bond yields become less competitive. Lower rates make corporate borrowing cheaper, boosting profits. Lower rates stimulate consumer spending, which drives revenue growth. Take away the expectation of rate cuts and you remove the foundation of the entire rally. The S&P 500 is trading near record highs right now. Price-to-earnings ratios are elevated. Market valuations assume that rates will fall and earnings will grow. If rates stay high or go higher, those assumptions collapse. Earnings get squeezed by higher borrowing costs. Consumer spending slows. Revenue growth stalls. And the market reprices everything downward. We have seen this before. In 2022, when the Federal Reserve raised rates aggressively, the S&P 500 fell 25%. The Nasdaq fell over 35%. Trillions of dollars in wealth evaporated. Retirement accounts were decimated. People who were planning to retire in 2023 had to postpone because their portfolios lost a third of their value. If the Fed signals that rate hikes are back on the table, we could see a similar or worse correction, because this time the market is more leveraged, corporate debt levels are higher, consumer debt is higher, government debt is at $36 trillion. The system has less capacity to absorb a shock than it did in 2022, and the shock could be bigger. Let me put this in historical context because what the Federal Reserve is facing right now has happened before. In the late 1970s, the Fed faced almost exactly the same dilemma. Inflation was persistent. The economy was weak. Political pressure to cut rates was intense. The Fed tried to thread the needle, cutting and raising in fits and starts, trying to please everyone. It pleased no one. Inflation spiraled. Confidence collapsed. It took Paul Volcker raising rates to 20% in 1981 to finally break inflation, but at the cost of the worst recession since the Great Depression. Unemployment hit 10.8%. Manufacturing was gutted. Entire communities were destroyed. The pain lasted years. We are not at that point yet, but we are on the same path. The same pattern of stubborn inflation, political pressure, and a central bank caught between impossible choices. And every time in history when a central bank has prioritized short-term political convenience over long-term price stability, the result has been catastrophic. Every single time. Turkey did it in 2021. Inflation hit 85%. Argentina has done it repeatedly. Their currency has lost 99% of its value over 20 years. Britain did it in the 1970s and nearly collapsed as an economy. The Federal Reserve knows this history. That is why they put the possibility of rate hikes into the minutes. They are telling the market and they are telling the White House that they will not sacrifice price stability for political convenience. But whether they can maintain that position under sustained political pressure, with an election cycle approaching, and with millions of Americans struggling under the weight of high borrowing costs, that remains the most important unanswered question in the global economy right now. The 2 dissenting votes in the January meeting tell you how divided the Fed already is. Governors Moran and Waller voted against holding rates steady. They wanted a 25 basis point cut immediately, citing softening in the labor market. So within the Federal Reserve itself, you have officials who want to raise rates and officials who want to cut them at the same meeting, looking at the same data. That level of disagreement at the top of the most powerful financial institution in the world should concern everyone. Because when the people in charge cannot agree on which direction to move, the risk of a policy mistake increases dramatically. And policy mistakes at the Federal Reserve do not hurt Wall Street. Wall Street has hedges and diversified portfolios and teams of analysts. Policy mistakes hurt you. They hurt your mortgage payment. They hurt your grocery bill. They hurt your job security. They hurt your retirement. Let me bring this down to what it means for your life right now and in the coming months. Because everything I have shown you leads to the same conclusion. The financial relief you were promised is not coming on schedule. It may not come at all. And the possibility exists that things get worse before they get better. If you have a variable rate mortgage or a home equity line of credit, your monthly payment is not going down anytime soon. It could go up. If you are carrying credit card debt, your interest charges will remain near record highs. Every month you carry a balance, you are losing money at 20% or more annually. If you are planning to buy a house, you cannot count on lower mortgage rates making homes affordable. At current rates, the median home in America requires a household income of over $100,000 to afford, and if rates rise, that threshold goes higher. If your retirement is invested primarily in stocks, you are exposed to a significant correction if the market realizes that rate cuts are not coming. A 25 to 30% decline from current levels would erase 3 to 4 years of gains. And if you work in an industry sensitive to interest rates, construction, real estate, automotive, retail, manufacturing, your job security depends on borrowing costs. Higher rates mean less demand. Less demand means layoffs. And in a high-debt economy, layoffs cascade quickly because unemployed workers default on loans, which hurts banks, which tightens lending, which hurts more businesses, which causes more layoffs. This is the reality that the Federal Reserve's January minutes revealed. Not the comfortable story about gradual rate cuts and soft landings, the real story. The story where the most powerful central bank in the world admits privately that it might need to raise rates into an economy where consumers are already drowning in debt, where political pressure is mounting from every direction, where inflation refuses to reach target, where the labor market is sending mixed signals, where global trade tensions are creating new inflationary pressures, where the government is running $2 trillion annual deficits that add stimulus to an economy the Fed is trying to cool. Every one of these factors pushes in a dangerous direction. And together they create a situation where the Federal Reserve has less control over outcomes than at any point in the last 40 years. They can raise rates and trigger a recession. They can cut rates and trigger inflation. They can hold steady and watch the economy slowly deteriorate under the weight of accumulated debt and stagnant real wages. There is no path that avoids pain. The only question is what kind of pain, how severe, and who bears the burden. And I need you to understand something critical about what is happening right now. The fact that the Federal Reserve put rate hike language into official meeting minutes is not a casual observation. It is a deliberate signal. Central banks communicate through carefully chosen words. Every phrase in FOMC minutes is debated and vetted before publication. When they include language about potential rate increases, they are preparing the market for the possibility. They are laying the groundwork so that if they do raise rates, they can point back to these minutes and say, we warned you. This is how the Federal Reserve manages expectations. This is how they prepare the ground for decisions that markets will not like. And right now, they are preparing the ground for something that contradicts everything the market believes and everything the White House demands. The January minutes are a warning that the comfortable narrative about falling rates and rising markets and economic recovery might be built on assumptions that the Federal Reserve itself does not share. A warning that the people who control monetary policy for the largest economy in the world see risks that the public is not being told about. A warning that the next move on interest rates could be the opposite of what everyone expects. And when the Federal Reserve surprises markets, when they do the opposite of what is priced in, the reaction is never gradual. It is violent. Stocks sell off in hours. Bond markets reprice overnight. Currency markets swing wildly. And the people who suffer most are ordinary Americans who never saw it coming because nobody told them it was possible. I am telling you, it is possible. The Federal Reserve themselves just told you it is possible. The question is whether you prepare for that possibility or whether you continue believing the comfortable story and wake up one morning to find that your financial assumptions were wrong and your window to adjust has closed. Subscribe to Market Acme right now because this situation is evolving rapidly. The next FOMC meeting could change everything. The next inflation report could tip the balance. The next employment report could shift the calculus. And the decisions being made inside the Federal Reserve right now will determine whether your mortgage payment goes up or down, whether your retirement grows or shrinks, whether your job is secure or at risk. These are not abstract policy discussions. This is your money, this is your future, and the warning signs are flashing right now for anyone willing to pay attention. I am Kenzo John, this is Market Acme, and I will keep showing you what the data actually says, not what they want you to believe, so you can make decisions based on reality, not false comfort. Because in the months ahead, the difference between those who prepared and those who did not will be measured in lost homes, lost savings, and lost years of financial progress that cannot be recovered. The Federal Reserve just told you that everything might change. The only question is whether you were listening.